Hello, everyone. Thank you for joining us. My name is Jessica Morgan, as many of you probably already know. I'm a partner at Tonkon Torp and today's moderator. Welcome to our webinar, What's in Store for Oregon Cannabis M&A. Today, our hope is to provide you with practical advice for your business so that it can thrive during a pandemic. Also, just to focus on a lot of the consolidation and market activity that's going on in Oregon. If you have unique questions for your business, we invite you to reach out to our panelists directly or to our Tonkon Torp lawyers who you normally work with for your specific situation. Today, we're going to hear from 5 panelists who are representatives from MGO and Tonkon Torp. As you know, Tonkon Torp is a business and litigation law firm serving public and private companies and individuals in Portland, the Pacific Northwest, and beyond. Our largest areas of practice include merger and acquisitions, litigation, employment law, real estate land use, government relations. We also have specialties in bankruptcy, creditor rights, business immigration, tax, and most recently, cannabis and hemp law, which is why we are here today. From the Tonkon side, we have Jeff Woodcox, who is the chair of the Tonkon Torp Merger and Acquisition Practice Group, focusing on merger and acquisition, corporate finance, securities, corporate governance. He generally advises on acquisition and disposition of businesses and assets, securities compliance, raising capital through private placements, and equity and debt. Then we have Danica Hibpshman, and a recent addition to Tonkon Torp's business department and cannabis industry practice group. She joined the firm after working with the Oregon Liquor Control Commission, which I will shorten to the OLCC, as you most know, for 5 years. During her tenure at the OLCC, Danica was a member of the initial policy team that developed and implemented the state's regulatory framework for Measure 91, which legalized the recreational use of marijuana in Oregon. From MGO, we have Scott Hammon, who is a partner and National Cannabis Practice Group leader. Scott is the leader of MGO National Cannabis Practice Group, has 30 years of experience assisting public and private companies in a variety of industries, significant work experience with growth companies, taken many companies public from development stage through IPO, M&A, or other transactions on domestic and international securities exchanges. We have Sanjay Agarwal, head of the National Tax Practice at the Silicon Valley location. Sanjay is an international tax expert with over a decade of tax experience. He also serves as the overall business advisor to clients, which consists of emerging and established technology and cannabis companies. And then we have Mark Hefner, who is the CEO and shareholder of MGO Realty Advisors, an affiliate of the MGO CPA Group. Mark is the real estate investment professional with 30 years of experience supporting investors and navigating commercial real estate markets, has a deep technical industry knowledge to help evaluate and optimize investment portfolios, conduct sales and purchases of property, and establishing joint venture arrangements. Now, that was a lot. Let me pause because I need to give you a little disclaimer about the format for this program. First, we are actively recording this webinar. You do not need to sign a disclosure and no private information of yours will be shared. Please know, however, that should you participate in our Q&A section, your question may be recorded in association with your name. You are welcome to submit your questions anonymously. Feel free to submit questions in the Q&A section of your Zoom app. I will do my best to ask each panelist a few questions as they come up. We want to make sure that we have time for everyone. So if you have a question that isn't answered right away, please wait till the end and I will try to get all of the questions answered, or we may follow up with additional questions following the webinar. We are going to conclude with the Q&A. We welcome any feedback you have after the webinar. If there are topics that you want to hear more about, please tell us. We want to be a source of information, make sure that you're getting the knowledge and experience from us as you need it. Finally, information presented here is current as of Thursday, January 28th, 2021, and is not intended to be legal advice. Phew. Okay. Thank you for paying attention through all of that. Now on to the more important part of our webinar here. I'm going to start with Scott Hammon from MGO. Scott, could you please just give us a little background about MGO and why we're partnering on this presentation?
Sure. No, thanks very much, Jessica. I'm happy to be on the call, the webinar today, and thanks to everybody who's joining in. MGO is a national public accounting consulting firm that has one of the broadest and deepest cannabis practices, and we're fortunate enough to share multiple clients that we work on together with the attorneys at Tonkon, Torp. And so one of the things that we had respectively noted in 2019, the late 19 and certainly into 2020, was an increase in M&A activity for a variety of reasons, some relating to infill activity, others looking for cost efficiencies, and then most recently just a valuation play. And so we thought it'd be a great time for us to collectively get together, and particularly with a focus on what's going on in the Oregon marketplace, try and provide a forum for people to talk about issues and questions they had. Related to that, about 2 months ago, we released our M&A field guide, and this is a kind of a practical guide for operators and investors in the industry, trying to give them some guidance and share some insights we've learned over the 6 years or so that we've been working in cannabis. Cannabis is a unique industry, and while there's certainly some aspects of an M&A transaction, they're the same regardless of industry. I think we've all found, those of us who are on this call, that there are certain nuances that if you're not aware of them can trip up a deal and at minimum make it a more costly and inefficient deal, or worst case scenario, kill the deal altogether. So since we've released the guide and we want to make people aware of that, we were happy to partner with Tonkon and get some good information out into folks' hands.
Thanks, Scott. You mentioned the field guide. Is there a way for the people that are attending this to access that field guide?
Thank you very much. I will slip you a small payment after the webinar. I didn't mention that. So you can find the field guide, the M&A field guide on our website. I can give you the reference now, but it's kind of an awkward reference, but it is available on our website, which is mgocpa.com. For those of you who want to shoot me an email, I'm happy to also provide you a direct link via email. But thanks very much for that reminder, Jessica.
Yeah, no problem. That's why I'm here. Okay, so from here, we're going to jump to Danica and get kind of the regulatory framework that is affecting M&A transactions. Danica, how do you feel the regulatory landscape in Oregon has changed? What should people be looking out for?
Yeah, thanks everyone for joining today. When Oregon first started issuing licenses back in 2016, it was a little bit of a wild west. There was no cap on the number of licenses. There was no limit on the number of licenses an individual business could hold, and they were relatively easy to obtain. And so what result was that between 2016 and 2018, the market flooded. And it became apparent that there were likely too many licensees, kind of an oversupply in the state. So Oregon did kind of put a de facto cap on licenses by pausing the processing of new applications in 2018. And so that really gave rise to a significant rise in M&A type transactions, because it was the only way for new entrants to enter the Oregon market was to buy into existing licenses. And also, I think a lot of existing licensees were seeing a much higher level of need to get additional capital, get investors in, and it was becoming really apparent that the original rules for cannabis that were adopted back in 2016 really didn't match the business needs of the industry, particularly as it was going through this very dynamic phase. There was lots of layers of approvals that needed to be done. There was lots of disclosures that needed to take place that were required. The process was incredibly long. It was not unusual for it to take a year to get a transaction approved through the regulatory bodies. And so it left a lot of unpredictability within the market of what businesses could or couldn't do. Definitely has had some changes recently. Things kind of came to a little bit of a head last summer within the industry of putting some pressure on the agency to really look at their licensing requirements to kind of make them match some of the business needs that the industry had. And the results, frankly, over the last few months have been really remarkable. The agency, OLCC, adopted some new rules back in October that really streamlined the processes, really reduced some of the areas that disclosures were required or even approvals were required, letting cannabis businesses, transact much more fluidly to get their financing needs met. But it really does open up a whole new world again for an easier regulatory framework for businesses to be working in terms of M&A transactions.
Thank you, Danica. Forgot to take myself off mute there. I just wonder, some of the stuff that you've been seeing, how do you feel Oregon compares to other states as far as, from a, structuring and just general regulatory oversight? Do you think Oregon has more oversight than other states and gets too far into the weeds?
No, I don't. I think that, there's often a lot of complaints about, over-regulation in Oregon, but compared to some other states, it's actually still not nearly as onerous. I do think that some of the changes Oregon is making right now is actually, it's lessons learned over the first 5 years of cannabis, and it's really being able to take the experiences that the Oregon regulators have had and learned what they do and don't need. We've really seen a lot of transition into wanting to be more business friendly, wanting to create regulations that actually work for the industry and their needs.
Do you think in these transactions that it's helpful to have an expert or someone that is trained in, compliance and just maybe personal relationships with the regulators?
I do, absolutely. And I felt that when I was a regulator and on this side of things as well. Because the regulations are complicated and there's lots of little pitfalls. Licenses are actually not quite as transferable as many of the industry believes they are. And there's certain hoops that must be jumped through to make sure that it's done effectively. And a lot of the changes that the agency is making recently in terms of streamlining licensing doesn't mean that certain things aren't required. It's just now going to be more dealt with on the compliance issue. So I think it's even more critical now to make sure that businesses are really engaging with their attorneys or consultants to make sure they've got all their ducks in a row and following the rules.
Great. Thanks, Danica. I'm going to jump over to MGO and Scott Hammon. You talked about your cannabis field guide. Can you give us a little bit of insight as to what the process of putting it together and what made you guys want to put it together and what's in it?
Yeah, no, happy. As I mentioned, MGO has a practice that, from a cannabis perspective, is across the U.S. And as I noted, we'd seen a lot of M&A activity, so that was kind of the driver for that. We definitely noticed there was an uptick. In terms of what's in it, it covers a broad cross section. I think it's a total of over 50 pages, and it's focused, in a serial approach. So it's got chapter by chapter, and it's walking through different components, including, as Danica just talked about, the importance of anticipating and working with the regulatory agencies. And as we all know in this industry, it's state by state, and in some states, it's region by region or locale by locale. So it's important to factor that in either on the buy side as part of your timeline and knowing how long it's going to take to get regulatory approval and what some of the pitfalls may be, or even on the sell side, understand how a more complicated regulatory environment is going to impact your valuation and the desire of a seller to engage with you. So that's an example of some of the things that we talk about. It. We also get deep into tax. Many of us have had experiences in this industry with the complexity of tax, not just 280E, which we're all familiar with, but also more traditional tax structuring issues that can really gum up the works. And perhaps almost as important or more important than 280E, most states, locales, jurisdictions have some form of excise or cannabis tax. And frequently that can create issues in terms of structuring earnouts, assessing liabilities and so forth. So, those are some of the things we talk about. I know we've got Mark on from our real estate group. We also discuss in the guide some of the issues around real estate and how to maximize return of value and have a plan for that. So it's really a pretty all-encompassing guide that we hope will help both, on the buy side and sell side, people have a more effective and efficient process through M&A.
Yeah, so thanks, Scott. I just wanted to ask you about, you mentioned valuation being one of those topics in the field guide. Does MGO get involved in the valuation process for for your clients, either before, during, after?
Sure, we absolutely can. Yeah, it's not, yeah, for our strategic clients, we'll absolutely support them and work with them in valuation, keeping in mind that we work in a lot of different areas within the industry. And sometimes if, for example, it's an audit client, we're prohibited from doing valuation work for them. But we absolutely have not only our own internal valuation people, but we also work with multiple valuation specialists outside the firm. So for a client or a non-client that's looking for a connection with somebody that understands the industry in general and specifically certain regional, because again, valuations are regional, we're happy to make a connection and help make a transaction happen.
Perfect, thanks. I think that comes up with our clients quite often, so it's good to know that you have that resource. Since you guys are involved in this quite often, what are some of the recent trends that you're seeing in the market?
I guess a couple things I would comment on. One, if you go back to the last wave of consolidation, that was really what I'll call a land grab, where it's all about obtaining the license, getting a presence in a particular state or region or locale. Now this most recent wave of M&A activity is really being driven by more strategic approaches to M&A. So you're seeing people that are selling because they want to reshuffle their locations for maximum cost efficiency, profitability. So you're seeing other folks do infill acquisitions to maybe fill out a geographic hole in their coverage. And overwhelmingly, we're seeing a focus, at least on the buy side, targeting profitable operators and brands. So, two trends that have happened, people are more interested than they ever were before in operations that are profitable and EBITDA accretive to themselves. And then secondly, I think brands have become much more important in this round of M&A than they were the last time. Again, last time it was very much a license focus. This time, I think people have started to understand the importance of brands. And so if you're a seller that does have a strong brand or brand portfolio, we're seeing those entities get a value premium over somebody that, while they may have a brand in the marketplace, if it doesn't have a dominant position, they're not going to get the same valuation.
That's helpful. When it comes to the transactions and the trends, are you seeing any trends with the multiples on EBITDAs? Or is it, like you said, I know that if you have brands in one company and license transfers, obviously those are completely different types of transactions. But if you're looking on a apples to apples kind of basis, are you seeing any trends there?
Yeah, definitely valuations are up, and because it's such a state by state, region by region issue, we're always hesitant to make direct comparisons. And so, the easiest way may be just to simply compare some of the publicly traded companies and compare where they were at the bottom of the trough, let's say, late or early first half of last year compared to where they are now. And certainly you're seeing 50%, increases in valuations in some cases, if not more. So, and you're seeing some of that play out regionally. However, I'll caution it is not across all locations. If, famously in Oklahoma, which is an unlimited license state, although that market as a whole has done very well, because it is an unlimited license state and there's a large number of competitors, you're not seeing the same increase there. We work with clients and non-clients in that area, and you're just not seeing that same valuation increase. So again, can't emphasize enough, valuation is driven by many factors, but one of them certainly is geography and the state regulatory environment.
Have you seen any trends with SPACs? And maybe you can kind of go into a little bit more detail on what that is for our webinar attendees.
Gee, Jessica, I've never heard the word SPAC used in cannabis at all the last 6 to 12 months. So SPAC is short for Special Purpose Acquisition Company or vehicle sometimes. And simply, it's sometimes also called a blind pool company, and it's a situation where a large amount of money is raised. That entity goes public as a shell, in essence, with just the cash used to raise and commitment of financing. So it becomes an acquisition vehicle. And it's become increasingly popular. I guess it started in the second half of 19 and just exploded in 2020. The number of SPAC companies in general went up probably 5x, I would say, if not more, during that time period. And certainly they've been used in cannabis. I wouldn't say for the first time, because you did see 1 or 2 SPACs a couple of years ago, but there are multiple SPACs that are looking for acquisitions in the cannabis industry right now. And that in part has driven some of the valuation increase, because that's a large pool of money that's looking for acquisition candidates, and that tends to drive up valuations. Probably the single biggest challenge if you're a seller and want to participate in a SPAC deal, because it's a public company, they have to roll the financials, at least on the initial process. You have to be PCAOB registered, or not, I'm sorry, have your audits done in accordance with PCAOB standards. That becomes, we frequently find, the single biggest gating item for a seller to participate in a SPAC acquisition. So if that's something that one of the listeners on this webinar is interested in, I would encourage you to start that process sooner than later. And if you do have those PCAOB financials in hand, or you can convert your existing GAAP financials quickly, that does give you a leg up in any negotiations and transactions. One of the curious things about the SPACs, they all come with an expiration date. And after a certain period of time, usually 2 to 3 years, if they haven't closed their acquisitions and used the funding that's available to them, they have to defund and return the capital unless the investors decide to extend. So that does provide a little bit of a ticking clock, which is great if you're a seller, because you might have a very motivated buyer.
Thank you, Scott. Really helpful information. Thank you for sharing. We're going to move on to a little bit more tax focused. So I'm going to start with Sanjay. How do you maximize value in an M&A transaction, focusing on the tax perspective, obviously?
Yeah, no, absolutely. So question that we're getting a lot nowadays, but there's two ways to look at this, right? On the buy side, for a buyer that's looking at purchasing, let's say, an Oregon operating company in the cannabis industry, the most important thing to look at is going to be what's going to result in a cash tax exposure, right? I mean, you want the overall tax efficiencies and everything else with the acquirer's structure and supply chain, but it's really going to be what results in a cash tax exposure. And what we see there is obviously 280E, which everyone knows about on this call, but there's some particular issues that have become very concerning as of recent, and we're advising a lot of companies now on the buy side with respect to 471C, for example. 471C is a provision that did allow, based on interpretation, certain taxpayers to deduct a tremendous amount of deductions that they wouldn't ordinarily be able to deduct had they just applied 280E as it applies. And a lot of smaller companies with gross receipts under 25 million, for example, claimed 471C on their 2019 returns, maybe even their 2018 returns if they were, if they did, have the opportunity to apply it then. But the government has officially shut down 471C now. And so what we're seeing is for companies that want to acquire operating companies, to the extent that they applied 471C, there's a lot of cash tax exposure there. And so, that you hit the point where you're going to want to have special indemnities or a purchase price reduction. And so, that's one area, on the buy side that's causing a lot of acquirers trouble right now. And then there's also just non-compliance with indirect taxes, right? Like the Oregon sales tax, for example, a lot of people are not compliant with that, either from a payment perspective or a filing perspective. And so that results, that could be up to like 20%. So that results in some exposures as well. And then the last way that we really derive value is by looking at the structure, like I talked about before. And if it's an asset purchase, looking at opportunities to bring a depreciable asset or an amortizable asset as it relates to goodwill into the buyer's structure and also into their consolidated tax returns. And there are some ways to do that, but it just requires more sophisticated planning than a lot of companies currently have in place. On the sell side, it's really just making sure that you're not in a position where you're getting past the LOI phase and you're getting into negotiations, and then all of a sudden the buyer, after discussing with their tax advisors and doing some quantitative work, getting the request for a special indemnity or purchase price reduction. That's what kills deals, and that's what leads to a failure of value on the sell side. So those are the main points that I think are notable.
Thanks. That is, I'm sure it's all very complicated. I know that some of these companies have some tax liens, and trying to deal with those after the fact is is always difficult. One question I have, and I'm not asking you for tax advice here, but when a company has, let's say, an IRS lien or a state issue with not paying payroll taxes or something, when the assets transfer over, should the sellers be concerned with any liability for those taxes going forward?
Absolutely. So, and I think, when you look at payroll taxes, those actually carry over under successor liability theories to the buyer as well. So the tax authorities can come after both parties, and that becomes a unique negotiation position there on special indemnities, and whether that's going to be a pre-closing liability or not, but it's just all subject to negotiation, right? But that is one liability that even in an asset transfer where the tax authorities can come after both parties.
Yeah, and this is Jeff. Hi, everybody. Like, that's actually pretty clear in the statute. There's a statute that actually provides for successor liability for payroll taxes for, even if you're purchasing substantially all the assets of a business. So that's definitely one that you want to focus on in a diligence perspective.
Absolutely.
So how are people dealing with these? You see probably, escrows or something is the traditional model without having the ability to utilize escrows in this industry to any real extent. What are people doing?
Yeah, I mean, definitely escrows are an option, or just having that special indemnity in there where the seller is going to be ultimately liable for that tax liability is another option. Or a lot of people are just outright requesting purchase price reductions at this point, just saying we're going to assume that we're liable for this tax and that we're going to get audited for it. We're going to factor in penalties and interest, and we're just going to reduce the purchase price.
Mm-hmm. Yeah.
I'd say also, like, to the extent that there are, if there's like a seller note in the deal, then making sure that you've got, from a buyer's perspective, making sure that you have like offset rights against that note to cover those sorts of liabilities, whether they're special indemnities or if it's an asset deal, it's just because there's, you've got an indemnity for any pre-closing operations of the business. That's another way I've seen people dealing with it.
Yep, that's a good point, Joe.
And because of all these complicated tax issues, what are sellers doing to avoid delays or cancellations of their transactions due to tax issues?
So a lot of companies are reaching out to tax advisors, both on the legal side and the accounting side, to do proactive sell-side due diligence. Right? They recognize the fact that they've taken aggressive tax positions in the past, or there might be some non-compliance. And so what we would do in that instance is we would come in and do a thorough review to really look at what are the two tax liabilities here and what's the ultimate cash tax exposure for a buyer that's coming in, and then looking at ways to remedy it, right? And there are certain things that you can do retroactively, but then it's also forward-looking as well. I mean, it's better to address like 280 allocations and methodologies that don't have any basis and get that in shape now, as opposed to letting 6 months or a year go by where you have one additional full year of tax exposure, right? So we look at it both retroactive and prospective as well. But there's definitely a lot of companies that are proactively doing that on their own, and we heavily encourage people to do that if they're looking at disposing of their business, right?
Mm-hmm. Yeah. So assuming that a seller is now interested in marketing their business for sale, then contacting a CPA to go through that analysis is what you would recommend.
Absolutely. Yeah. And the other thing too, Jessica, on that note is, with potential tax reform, the capital gains rate to the extent that there's a capital gain of over $1 million may go up from 20% to 39.6%. And so that's also driving a lot of deals right now. I mean, you look at just consolidation in the cannabis industry itself, but when you couple that with this increase in the capital gains rate, it's really driving a lot of deals and, the desire to sell now in 2021 as opposed to 2022 when the capital gains rate might be double what it is now.
Jessica, if I could maybe chime in on something sorry to
Yeah.
jump in, but Sanjay made reference to CPA, and this, I don't want to sound like we're touting our own horn or your horn, but I would clarify for all the participants on the webinar today, it's important you do have somebody who understands the industry, both from a public accounting side, tax side, and in the case of Tonkon Torp on the legal side. So for those of you who are listening, you will want to make sure whichever CPA or legal firm you're working with does have deep industry expertise, because if not, you can really wind up in a pickle.
Right.
Yeah, that's good to know and always be reminded of. Sanjay, I'm also going to ask you of what kind of impact on M&A transactions do you see from the IRS regarding recent tax audits in the cannabis industry?
Yeah, absolutely. So there's definitely an uptick in audits. Cannabis is the low-hanging fruit, and a lot of cannabis operating companies have special disclosures in their return, which is a Form 8275, which basically is a statement that the paid preparer would include in the return. It's a red flag for the IRS, right? I mean, anytime they see that in the return, they know that there's a position taking in the return that doesn't meet the substantial authority test, which is a greater than 40% chance of success on audit. So they view that as low-hanging fruit for them. And when we're coming out of a COVID environment and the desire for governments to raise money both at the federal and the state level, there's definitely more focus now on tax due diligence as it relates to buy side and sell side, right? Because buyers are aware that if they buy a company that's taken risky positions in the past, there's a good chance that they may get audited, within the statute of limitations period. And we might even run into issues where so much has been deducted that shouldn't have been deducted, where the statute is even extended past 3 years. So because there's a substantial understatement of gross income. And so it's a heavy focus area right now. And that's why I really encourage everyone that's contemplating on disposing of their business via stock sale or some type of asset transaction to really do the sell side due diligence so that they don't have a dead deal in the future or have some type of special indemnity that haunts them for years to come.
Thank you, Sanjay. That's really helpful and kind of scary. So, so I'm going to move on to Jeff. I see that we're getting some questions in the Q&A. I just want to let the participants know that we will be getting to questions after I go through each of the panelists, and then if there's any other questions that come up post webinar, feel free to reach out to any of us on any of the topics that we're discussing today. So Jeff, in the legal side, how do you think the cannabis industry regulatory scheme impacts the deal structure generally?
Yeah, thanks, Jessica. I think the biggest impact is this mandatory approval requirement that OLCC has in place before a transaction can close. And Danica kind of hit on this a little bit in the top of the presentation, but the OLCC has to approve the license transfer from the seller to the buyer before the transaction can close. And what that means is that for most cannabis transactions in Oregon, we can't do what people think of as simultaneous sign and close, where you execute the purchase agreement and you close on the same day. Instead, you sign the definitive transaction agreements, you start your process for seeking OLCC regulatory relief or regulatory approval, and then you close when that comes in. And that happens all the time in M&A transactions. It just has to happen here because of this regulatory approval requirement that we have. And sometimes that doesn't necessarily meet the business needs for the buyer and seller. So we might be talking about a distressed asset or an asset that the seller would be shuttering but for this transaction. So from a transaction structuring standpoint, we have to think about ways that we can accommodate the business situation that the buyer and seller are in, but still comply with the Oregon regulatory requirement that the OLCC approve the license transfer before the transaction closes. And one of the ways that we do that is through what's called a management services agreement. So when we sign the definitive transaction agreement, we've got this gap period between signing and closing, but during that time, we have a management services agreement that the buyer and seller will enter into that will, effectively give the buyer the ability to run and control the operations. And there are limitations on what you can do with that. And Danica could give us more details on what those look like to make sure that they pass muster from an OLCC perspective, meaning that the OLCC will respect it as a management services arrangement and not some sort of a disguised sale. But that's, I think, one of the biggest ways that the Oregon cannabis rules affect transaction structuring. In a lot of ways, it's like any other M&A transaction, but that's just sort of a particular feature of Oregon law that can get folks hung up.
Yeah, and I would, I'm going to ask Danica to maybe give us a little bit of her regulatory perspective on those management agreements and what you're seeing from the regulators.
Yeah, and the key issue with them is, until, under OLCC's requirements, until they've actually approved the transaction and then the components with it, the buyer cannot actually be, effectively operating or taking over control. But I think with some of the recent changes that are being proposed, I think some of that is actually going to be made a little bit easier and addressed. And another way I think some of the changes they made that at least help some of these issues is it's incredibly shortened the time frame in which the parties have to go through before they get that approval. Like I mentioned before, it used to be upwards of a year to get a full approval. Now it's potentially between 30 to 90 days. So it's definitely problematic, but at least getting better in terms of the gap in time where that has to be in place.
Right, and Danica, and I think, correct me if I'm wrong, but there are other ways that we could try to shorten that period by submitting the LOI or something short of a definitive agreement, as long as it's got material terms to the OLCC, so that we can, the folks can get into the queue for OLCC review.
Right, and we recommend that, frequently, just to get that process started. OLCC does not actually definitively require a written agreement between the parties, and so that process of getting the licensing moving can happen before there are definitive agreements. Absolutely.
Yeah, and I understand there are other states that are approaching this in a different way. For example, my understanding is that in Michigan, for example, the parties can go ahead and close the transaction, and there's sort of this post-closing review period that the Michigan regulatory authorities can go through. Obviously, there are downsides to that because it's complicated if you've actually closed a transaction to then unwind it if the Michigan bar didn't come through. Exactly. But is there any sense that Oregon might be venturing that direction?
Yes, and I think Michigan's model is really a good example of one that it's a state that became legalized after a number of other states had and kind of had figured some things out. I think that Michigan really learned that accommodating those business realities at the outset is really important to have a good industry in your state. So I think that what I'm really seeing is a lot of interest in the Oregon regulators in making sure that Oregon is a business friendly place. They're really listening to these issues and working through them, holding a number of stakeholder advisory meetings that we're part of to get that feedback. And these types of issues are the ones that they're expressing a lot of interest in learning more about what they can do to help.
Yeah, sure.
So Jeff, you mentioned, starting the OLCC process with an LOI. In my experience, and maybe yours is a little more sophisticated, a lot of my deals get to me and they're like, oh, here's an email with bullet points. We did a handshake. This is what we're going to do. Please start documenting it. How important do you think the LOI stage is?
Well, I think that the LOI stage is really important in M&A transactions generally, not limited to cannabis deals, just to make sure that everybody is on the same page as to the key deal points that are going to govern the transaction. It's not essential. Most LOIs are going to be non-binding for the most part, but to make sure that you, generally speaking, have a meeting of the minds as to critical issues can help negotiations when it comes to drafting and negotiating the definitive documentation go much more smoothly, and can iron out issues, and not just legal or financial, but also relationship. Like, how does it go negotiating an LOI with this potential buyer? And if not great, then that's something to consider in terms of moving forward. So again, it's not something that is mission critical, but I think to the extent that the transaction has the time available for negotiating an LOI and getting those key deal points hammered out, it's definitely beneficial in having a smooth transaction.
And when we say smooth transaction, it's not just, time involved and complexity, it's also legal expense.
Right. Exactly. Yeah, exactly.
So how do you think the M&A cannabis industry, I mean, you mentioned it generally just before about the original structure being a sign and close, but what other considerations should people in the cannabis industry take into account when they're doing these?
I mean, I think that, in that sort of structuring question with simultaneous sign and close and the management services agreements, obviously we've got that special consideration for OLCC approval. We've got special consideration for regulatory issues around how the business has been operated and are there any violations that we need to look at. Beyond that, I think that, M&A in the cannabis industry is similar to M&A in any other industry. We're looking at, are we doing a stock deal? Are we doing an asset deal? Are we doing a merger? And the considerations for that are, third-party consents, tax implications, what liabilities are getting assumed. So a lot of those considerations are the same. I would note that, even if you do a stock deal, which can sometimes get over having to go out and get some third party or governmental approvals because the entity isn't changing, that's not true for the OLCC. So even if you do a stock transaction, you still are going to have to get that OLCC approval. But I would say by and large, other than sort of making sure that you are diligencing and documenting those regulatory issues and compliance, the things, the considerations between a cannabis M&A deal and any other M&A deal are largely the same.
And, I've seen complicated deals in both sides, cannabis industry and other, but when we're talking about consideration, I know a lot of times in our cannabis deals, there's companies that are coming together. So there's a lot of different ways people are structuring how they pay for the assets. Can you just talk about some of that a little bit?
Sure. Yeah, I mean, the two key ways that we see consideration for the assets being acquired are through, assumption of debt might be one. If the seller has some sort of loan that it's not going to get paid off at closing, then part of the consideration is the fact that the buyer is going to take on that debt. Another one is cash. Cash is king. It's the easiest one for sure. And then I would say one thing we see more often in M&A transactions than other transactions is the use of stock of the buyer entity as consideration for the assets. And that does complicate things a little bit more because, anytime you've got stock as consideration, you have to think through what sort of securities law compliance issues there might be. So from the seller's perspective, you're looking, or from the buyer's perspective, you're sort of looking at, I'm not going to register this issuance because registering securities issuances, it's expensive. So you're going to look for some sort of an exemption from the registration requirements. So who are you issuing the securities to? Are they accredited investors? From the seller's perspective, securities are a little bit more speculative, right, than cash. So that might be a reason that you want to do a little bit more heightened due diligence on the buyer and the securities that you're getting and what their business operations are. How are you valuing the securities that you're getting? What's the liquidity? Is it a Canadian traded buyer that you have some liquidity on the Canadian stock exchange? Is it a private company, so you're going to have to hold those securities for an indefinite period of time? But I would say on whole, yes, we definitely see more transactions in the cannabis space that have a majority or entirely consideration in stock, and that definitely raises additional issues from both the buyer and the seller perspective that you would want to think through.
I'm going to ask Sanjay to maybe talk about what he's seeing as far as tax complications with the different types of consideration that people are are outlining in their agreement?
Yeah, that's a great question. So because of today's financial economic environment, we're definitely seeing more heavy stock consideration in deals, just given the lack of overall cash in operating companies or the desire to hold on to such cash and just issue stock. So the interesting thing is if you're looking to acquire a company, depending on what the consideration consists of, okay, you might run into a situation where a seller is taxed on all of the consideration, so the cash received plus the fair market value of the stock received, but the cash that they receive is just enough to cover the entire tax bill or not enough. So they actually have to cut a check as a result of the deal. And so what we encourage people to do is look at strategic ways and creative ways to try to fall under one of the tax-free reorganization provisions. So there is something referred to as a reverse subsidiary merger that we employ very commonly in the cannabis industry. And it basically requires that 80% of the total consideration as of the date of the signing of the definitive documents consists of stock of the acquiring company or the acquiring company's parent company. And then basically you have the option to use 20% cash or promissory note or other types of cash equivalents. And so that allows the seller to say, I'm going to pay tax on the 20% cash equivalents that I receive, but I don't have to pay any tax on the 80% stock consideration. And so that just makes it, from a buyer's perspective, that's going to help you close the deal if it's a target that you want for your structure and your growth plans. And then from the seller's perspective, it's going to get them to sign the agreement and actually go through with the deal because their tax bill is significantly minimized, right? And so that's one issue that comes up a lot. And the reason why the reverse subsidiary merger is also really good for cannabis operating companies is that the target remains in existence for legal purposes. And maybe Jeff can speak to this, but that means that from a regulatory perspective and from a financial perspective and all these non-tax reasons, just having the target remain in existence is very helpful and makes the deal less burdensome, right? So I don't know, Jeff, if there's anything you want to add to that.
Taking myself off mute. Sorry. Yeah, I think that's absolutely right. I mean, it has some of the benefits of a stock deal, right? I mean, so that entity stays in place, and so to the extent that you've got third-party consents that you have to get with an asset deal, you might not have to get those if you did that reverse merger or you did a stock deal. So it can definitely streamline the process over the asset alternative.
Absolutely.
Well, thank you, Jeff and Sanjay. I may come back to you at the end about boot issues on assumption of liabilities, but we'll save that. I want to jump into real estate issues at this point, and so I'm going to jump to Mark. Hello, Mark. Thank you for being patient. When you are dealing in M&A work and real estate issues, what does it mean to be proactive on real estate issues?
Well, I think Sanjay touched on the tax side earlier, and the same applies to physical real estate. So whether you're a target or an acquirer, we absolutely advocate for getting your house in order. So if you are the target, that means build a good due diligence vault, know what your property is, what it isn't. Run preliminary title reports so that instead of going headlong into a transaction without really thinking your real estate, but all too often companies really don't know. Then you're finding out, okay, so before we engage, now we know we need to clean up some items on our preliminary title report. We actually don't know how big our cultivation facilities are. There are things that you assume that if you actually dig into the weeds, you don't. And on the acquiring side, the same holds true. You have to challenge the assumptions that are presented to you. And that means bringing in your own team. So I think that is critical. And this applies not just to the cannabis industry, it applies to other industries too. Principals go headlong into acquisitions or dispositions and they have their eye on some tangible something, but then there are lots of moving parts. Real estate tends to be that. So acquirers need to understand, first of all, does the real estate that they're ending up with, does it actually align with their business objectives? So these seem like kind of simple givens, but people get excited in transactions and they lose discipline. So I think one of it, I know that our time is short, Jessica, and I think probably we would all like to hear more from the audience with questions, but those are big takeaways. Do your homework, make sure that the real estate you end up with aligns with your business objectives, because very frequently they don't mesh well, or they don't mesh at all. The last thing, unless you have a question to fire at me, is that from practical experience now, not just in Oregon, but across the country, where we advise cannabis companies, sale leasebacks are way easier and in most cases less expensive to allow you to monetize assets, to redeploy cash in your business than cannabis real estate debt. Very finite market, cannabis real estate debt. They look to traditional commercial valuations generally. So a sale leaseback avenue is something that I would encourage people to explore.
That's great. That actually answers one of the questions on our question and answer. So thank you for jumping on that one. I am going to jump to Q&A just because we're getting a few questions, and I think that might help, get some of the stuff that you guys were maybe going to present on already. But the first question was, how are buyers and sellers finding one another? And I know that Scott jumped in on that already and typed an answer for everyone. So thank you for doing that. But I just wanted to put it out to the rest of the group, from the legal side, from Tonkon's perspective, how are we seeing clients get connected? Jeff, if you want to jump on that one.
Need to unmute again. Yeah, from my experience, like a lot of that's happening from just sort of existing networks in the industry, like largely. I'm not seeing a lot of, auction processes, for example, that we see in other M&A areas. I think in my experience with the cannabis industry, mostly it's through investing or through existing network connections.
So I am looking at the Q&A, and I think maybe Scott, do you want to jump on this question of, are you seeing valuations based on multipliers of revenues or profits? And if so, what's the range? I know that's always everyone's question.
I feel like a politician. I'm going to try and avoid the question. So valuations certainly have flipped to be more of I'd say EBITDA and profitability metrics. Revenue, you still see top line revenue, but I think a lot of the buyers, because they are focused on acquiring accretive or profitable operations, are now emphasizing more EBITDA or profitability measures. But you still see revenue. And then in terms of the multiples, I don't even want to talk about that because it's all over the map. Simply because it depends, what segment you are in of the industry. It depends on what geographic locale. I mentioned Oklahoma earlier. It's unusual to get much over 1x maybe in Oklahoma top line revenue, but in some other markets you're going to see substantially more than that. So what I would suggest is, and feel free to reach out if you want to talk about a specific scenario, but you can find some data if you start searching by a more limited basis. So if you're interested in what it is in your region, you can see comparable deals and get information about that. And again, happy to discuss offline about specific circumstances. Did I tap dance well enough on that one?
Yeah, good job. I would say that from Tonkon's perspective, we do have access to some resources that can help pull some numbers from what's going on in the general market. So if you need help on what's going on, we can give you a general idea. But depending on the type of transaction, obviously people are doing a lot of license transfers, and that doesn't really factor in other than maybe just adding to your valuation. So I guess I'm going to go back to Danica really quick and just see, what changes you see maybe in Oregon. I know that there's a few rule meetings that are coming up, and may affect people in the cannabis industry in Oregon.
Yeah, I think what I anticipate is just a continued kind of honing of the regulatory environment. Like I mentioned earlier, I think it's just become apparent that it needs to be, business friendly, and I think that the regulators are very open to that. I'd also talked about the pause on license applications. There has been some talk recently from the agency of potentially lifting the pause on non-producer licenses. Not sure if that's going to happen, but at least it's something on the horizon that might change, how license transactions move forward. Oregon's also going to have kind of a leading role in this new regulators association of all other legalized states. And so I think, some of the work that Oregon's doing to make the business environment more friendly and make the regulatory approvals easier is going to be really important for that group as other states look to Oregon to frame their regulations.
Thank you. Thank you to all of our panelists. I'm going to just ask if there's any last few words that you want to make sure, if I didn't cover something, if you want to jump in, and then I'll just wait to see if there's any other questions that pop up on the Q&A. But just want to say thank you to everyone. I really appreciate you getting on and taking the time to give us your expertise.
Thank you.
Thanks a lot.
Yeah, happy to participate.
Thank you.
And if any of our attendees have additional questions, all of us have our emails on the Zoom. So, if you want to write those down, or if you just want to reach out to the registration, the place where you registered, our marketing department can connect you with any one of us. We'll also be following up with some emails, and we just really appreciate you all attending today. Thank you.